There is a number sitting in the silver market right now that most retail investors have not seen yet, and when I pulled it up this morning, it stopped me cold. The price of silver in Asia is nearly $4 higher per ounce than the price you are seeing quoted in London and New York. Same metal, same ounce, different continent, nearly $4 apart. That gap, $3.36 to be precise, is the largest east-west silver premium we have seen at any point in the 2026 trading year. And what it is telling us about the physical market, about COMEX, and about where that metal is actually going is what this entire video is about. I am going to show you why that gap exists, what it means for someone holding physical silver in the US or the UK right now, and the one specific thing I'm watching this week that will tell me whether this divergence is about to close or accelerate. My name is John, 15 years in FX and commodities before I ever picked up a camera. I left that world because I believed the people watching their savings from home deserved the same level of analysis the institutions were getting. That is what we do here at Currency Insider. Everything I show you today comes from publicly available sources, and I will name everyone as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, now is the time, because what we are covering today connects directly to a bigger picture we have been building week by week on this channel. Today, we are covering three things. First, what that $3.36 premium actually means, and why the mechanism behind it matters more than the number itself. Second, how the dollar's move below 100 is interacting with this divergence in ways that most coverage is missing. Third, the three lanes framework for this specific setup so you know exactly what to watch and what it means when you see it. Last week, I told you to watch the Asian futures session after the 8 p.m. Iran deadline passed, specifically whether silver could hold $72 on any pullback. Silver is currently sitting at $72.44. That level held. I am putting that on record right now because that is how this channel operates. The call was specific, the outcome is specific, and we do not move the goalposts. Now let us build on that because what happened after that deadline, and specifically what happened in Asian markets overnight, is directly connected to the story we are covering today. Before we get into the data, I want you to drop something in the comments right now. Are you seeing elevated premiums at your local dealer this week compared to 2 or 3 weeks ago? Or has the over-the-counter premium stayed roughly flat? The comment section here becomes a real-time ground-level read on physical market conditions, and I read every single one. Here is what the price action is telling us right now. Silver at $72.44 in London and New York. Silver at effectively $75.80 in Asia. When you add that $3.36 premium to the Western spot price. That is not a rounding error. That is not a data glitch. That is the physical market in the East telling you something the paper market in the West has not yet priced in. And the reason this matters to you specifically, if you are sitting in Ohio or Manchester holding silver, is that the price you see on your screen is increasingly disconnected from the price it costs to actually acquire a physical 1,000-ounce bar in the real world. This is not a new dynamic. The East-West silver premium has widened and narrowed in cycles over the past decade. But the fact that we are sitting at the largest gap of the 2026 trading year, at the same time the DXY has broken below 100, at the same time geopolitical risk around the Strait of Hormuz is elevated, that combination of factors is what makes this specific moment worth paying close attention to. Let me explain exactly what is creating this gap, because understanding the mechanism is more useful than just knowing the number exists. When physical silver is cheaper in the West than in the East, a very specific trade becomes attractive to anyone with the capital and the logistics to execute it. You buy silver in London or New York at the lower price. You ship it east. You sell it at the higher price. You pocket the difference, minus transport and insurance costs. This is arbitrage in its most basic form. And when arbitrage is happening at scale, the physical consequence is that metal flows from west to east. COMEX-accessible vaults lose inventory. The premium in the east stays elevated or widens further. And the Western paper price, the COMEX futures price, faces upward pressure because the physical supply it is supposed to represent is quietly leaving the system. Think of it like a garden with 2 ponds connected by a pipe. One pond is London and New York. One pond is Shanghai and Tokyo. When the water level, the price, is higher on the east side, water flows through the pipe from west to east until the levels equalize. The pipe in this case is the arbitrage trade. The water is physical silver. And right now the east pond is sitting nearly $4 higher. That pipe is running hard. The data I want you to focus on is this. The Shanghai Futures Exchange premium over COMEX spot, when I looked at the most recent available figures, is sitting at that $3.36 level. The Silver Institute's ongoing supply and demand research has documented a structural multi-year deficit in the silver market. That deficit context matters here because it means the Western vaults that are losing metal to this arbitrage trade are not being replenished at the rate they historically were. The buffer is thinner than the headline inventory number suggests. Now here is the layer that most of the coverage on this premium story is missing, and this is where the dollar comes in. The DXY fell to 99.91. For viewers who follow currencies, you know that the 100 level on the dollar index is psychologically and technically significant. It is a level that algorithmic trading systems are programmed to respond to. When the DXY broke below 100 this week, it triggered a wave of algorithmic buying in silver futures. That buying pushed the COMEX futures price up to test the $73 resistance level. Now here is why that interaction with the East-West premium matters specifically. A weaker dollar makes silver cheaper for buyers operating in other currencies: yen, yuan, rupee, euro. It effectively gives Asian buyers a discount on top of a market where they were already paying a premium. So the dollar weakness is simultaneously pulling Asian demand higher and pushing Western paper prices higher. Both forces are working in the same direction, and they are working at the same time as the 10-year Treasury yield sits at 4.35%, a level that in almost any previous cycle would have been acting as a ceiling for non-yielding assets like silver. The fact that it is not acting as a ceiling right now, that silver is pushing higher despite yields at 4.35, tells you something important about how the market is interpreting current conditions. It is treating silver not as a commodity trade, but as a monetary hedge. When inflation expectations and geopolitical risk are the primary drivers, yield becomes noise. I have watched that shift happen in real markets before. When it happens, the moves tend to be larger and faster than most people positioned for. If you know someone who has been watching this silver move this week and trying to make sense of it, share this video with them right now. This breakdown took real time to put together, and the people who need it most are probably not searching for it by name. There is a second thing I want to cover in this section that connects the East-West story to the UK specifically. The LBMA, the London Bullion Market Association, is the primary pricing mechanism for physical silver in the Western world. The LBMA silver price is the benchmark that most large physical transactions reference. When there is a significant and sustained premium in Asian markets over LBMA pricing, it creates pressure on the LBMA itself to reflect the true cost of acquiring physical metal. The LBMA vault data, which is published and publicly available, has been showing a trend of declining physical silver holdings in London vaults over recent quarters. That declining trend, when combined with an active arbitrage flow pulling metal east, is the structural picture that the $3.36 premium is pointing at. For UK investors holding silver in a SIPP, the sterling-denominated silver price has an additional tailwind right now. Pound weakness against a broadly weakening dollar environment, which is a strange but real dynamic where both currencies are softening against hard assets, has meant that British holders of physical silver have been seeing gains amplified in local currency terms compared to the raw COMEX number. That is worth understanding when you are thinking about your position sizing and your risk. All right. Let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1, the paper market. COMEX silver futures at $72.44, testing $73 resistance after algorithmic buying triggered by the DXY breaking below 100. The CFTC commitment of traders data this week shows net long positioning in silver. That positioning was built partly on geopolitical risk and partly on the dollar weakness narrative. If the DXY recovers back toward 102, which the bearish scenario in the data I reviewed this week identifies as the key level for shorts to gain traction, those longs face pressure. A move back to $69 on silver in that scenario is the number I have seen cited, and I want to be honest with you that it is a live possibility. Lane 2, the physical market. The $3.36 Asia premium against LBMA spot is the dominant signal this week. The arbitrage flow it implies, metal moving west to east through the pipe, is the mechanism by which COMEX registered inventory gets quietly reduced over time. The Silver Institute structural deficit data sits underneath all of this as a medium-term amplifier. Lane 3, the macro, DXY at 99.91, is the number driving algorithmic behavior right now. 10-year yield at 4.35 is being treated as a fiscal symptom rather than a monetary ceiling. Geopolitical risk around Iran remains elevated and unresolved. In 15 years watching currency and commodity markets, the times I have seen all three lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying it is worth knowing what to watch for. When the paper lane is showing net long positioning, while the physical lane is signaling an active east-west drain, and the macro lane is removing the dollar as a counterweight to metals, the historical pattern has been that the resolution of that tension tends to happen faster and more violently than anyone models for. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week: the $3.36 Asia premium. Specifically, I am watching whether it narrows or widens over the next 5 trading sessions. Here is the threshold that matters. If the premium stays above $3, above roughly a 4% spread over Western spot, the arbitrage trade remains economically viable and the drain continues. If it narrows below $2, it tells me the flow is slowing, possibly because COMEX is beginning to reprice toward the physical reality, or because Asian demand is softening. The data release I am watching for context is the next CME warehouse report showing registered silver inventory. If registered ounces drop further in the same week the premium stays elevated, both things happening together, that is the confirmation signal that the drain is accelerating, not pausing. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. The Asia premium stays above $3, and sustained arbitrage flow continues to reduce COMEX registered inventory. At some point, and the bullish scenario in the data I reviewed this week puts a 4% premium as the trigger level, COMEX futures pricing is forced to move toward the physical reality rather than the physical reality moving toward the paper price. In that scenario, silver tests $76, the gap closes from below, and Western holders of physical silver have effectively been sitting on underpriced metal relative to what the East has been paying all along. Here is what needs to happen for the cautious picture instead. The DXY recovers. A stronger dollar makes Asian purchases more expensive in local currency terms, cooling Eastern demand and allowing the premium to compress naturally. Simultaneously, the geopolitical risk premium fades as the Iran situation de-escalates. In that environment, silver futures face selling pressure, the $73 resistance holds, and a move back towards $69 is the number to watch. Both of those scenarios are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the 2 questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach the people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers. First, are you currently holding physical silver, paper silver, or both? And has today's breakdown on the East-West premium changed how you are thinking about that split? Second, have you personally noticed a difference between the spot price you see quoted and the actual premium you are paying at your dealer right now? Drop both answers below. The comment section here becomes a real-time ground-level data point on what the physical market actually looks like from your side of the counter, and I read every single one. Subscribe because next week we are following up on exactly what happened to that Asia premium. Did it hold above $3 or did it compress? And I will show you what the CME warehouse data look like in the same window. That follow-through is the whole point of this channel. And if someone in your life is watching their silver stack right now and feeling confused about why the price on their screen does not match what their dealer is actually quoting them, share this with them. That disconnect is exactly what we explained today. This is Currency Insider. Know the market, protect your currency.